1 year ago, Little Rock appeared to be an apartment market on the rise, but over the past 4 quarters, apartment fundamentals have really cooled off. Welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons with your Little Rock update. Back in second quarter of 2011, Little Rock appeared to be one of the more solid secondary markets in the South. Occupancy at the time came in at 94%, which was up 220 basis points year over year. Rents were up 3.9% annually, which was above the national average at the time. And look what's happened since then, starting with occupancy. Occupancy fell in 3 of the past 4 quarters, adding up to a drop of 130 basis points year over year. That brought the rate to 92.7%, which now puts Little Rock in the bottom tier of markets. Now, I should point out that demand was actually positive in the past year, but still pretty limited at 457 units, and at the same time, the metro added about 1,000 new units, so that's why occupancy fell. And let's take a look at annual rent change by quarter. You can see that the 3.9% hike in Q2 of 11 turned out to be the cycle's peak. And rent growth levels have really dropped off since then. As of Q2 2012, rents were up just 1.6% year over year, putting Little Rock in the nation's bottom quintile by that measure as well. And interestingly, the market slowdown traces to what's happening in the local economy. Take a look at this chart showing annual job change by quarter, and you can see that job growth levels bounced back pretty quickly in late 2010, early 2011, which likely boosted apartment fundamentals at the time, only to drop off since then. And as of Q2 2012, Little Rock was back in the red, down 400 jobs year over year. And as a result, apartment fundamentals have really cooled off across the board. But as usual, there still are some clear winners and losers in the market. Occupancy rates are much better in newer units and in higher price submarkets, which is true across many of the markets in the South. Take a look at occupancy rates by age. Every group has seen some easing, but the rates are still strong at the top, 95.9 in the 1990s segment, and 94.9 in apartments built since 2000. But terrible rates in older units, 90.4 in the 70s and just 87% in apartments built prior to 2000. And take a look at occupancy rates in Little Rock's 4 submarkets, and you can see there are better rates in the 2 higher priced submarkets, 95.3 in West Little Rock, Saline County, and 94.9% in downtown Little Rock. Weaker rates in the other 2 submarkets, especially in the central Little Rock, southeast Pulaski County area, just 89.8% full. So what does all that mean for the outlook for Little Rock's apartment market? Well, obviously it all depends on what happens in the local economy. And economists are expecting for job growth to pick back up in the year ahead, and that should allow for apartment fundamentals to start improving again, but that's probably going to come at a modest to moderate pace. So that wraps up for Little Rock. So until next time, for Apartment Market Dynamics and MPF Research, I'm Jay Parsons. Thank you for watching.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.